Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me for the segment, we have Tushar Aggarwal, founder and CEO of Persistence, to discuss the role of liquid staking in DeFi. Tushar, it's great to have you with us. Welcome to Trade Talks.
Thanks, Jill, for having me.
Explain to us what liquid staking is and how it's supercharging DeFi.
Okay, before going to liquid staking, let's spend 30 seconds talking about staking. A lot of your listeners might be familiar with Bitcoin. Bitcoin follows a consensus mechanism called proof of work. What that means is the Bitcoin blockchain essentially adds transactions to the chain through a consensus mechanism, where all the miners come to consensus on which transactions should be included on the Bitcoin network. They use a consensus mechanism called proof of work. As we know, proof of work comes with a lot of overheads in terms of being not that environmentally friendly, in terms of being extremely resource heavy. And so an alternative consensus mechanism called proof of stake, which is sort of academically, it's been present for a very long time. It's existed in production technologically for a few years now, primarily since 2018 with the launch of Cosmos and Tezos. Essentially, how proof of stake works is you have to stake your asset. Anyone holding ETH, for example, once the merge happens and ETH transitions to proof of stake, anyone can stake ETH to be part of the consensus and hence get rewarded in more Ethereum, because obviously you're taking risk to mine new blocks. The problem with staking is that once you stake, even though you're getting rewards, your asset becomes illiquid. What liquid staking essentially is, we issue a representative asset. So while you're earning staking rewards in the background, you still have a liquid asset that you can use within the broader DeFi space, whether to supply liquidity to a decentralized exchange, whether to use it as collateral to facilitate borrowing lending.
So how is it possible to access tokens while they're staked? Isn't that inherently risky?
Essentially, this is done through smart contracts. What happens is that if you stake through the pStake platform, pStake is the liquid staking application that is developed by Persistence, which is the company that I run. If you stake through pStake, the application, what happens is essentially in the background, the assets get staked to a set of whitelisted validators. These whitelisted validators are essentially validators that have initially been cherry-picked by the team based on certain metrics, such as how robust their architecture and infrastructure is, how much uptime they've had, if they've missed any blocks, and a bunch of other parameters that the team evaluates validators on. Over time, we want to sort of allow the community or token holders to be able to determine what validators become part of this whitelisted validator set. So essentially, that's what happens. So, instead of staking with just one validator, if you stake via pStake, in the background, it gets distributed to a bunch of validators. So you essentially are mitigating risk at some level. Where you're increasing risk at some level is pStake is issuing you a representative token. And so essentially, because the delegation to multiple validators is happening through smart contracts, there is the additional risk of being exposed to smart contract risk. But essentially, that's basically, liquid staking allows you to get more capital efficiency, but that comes at a cost in terms of additional risk as well.
Right. And that's why I'm pressing a bit, because we have seen systemic breakdown in a number of areas of the crypto space most recently, because when you stake, you can, in effect, get anywhere from 10 to 15% yield. I mean, that looks great on paper, right? But some of these assets have also dropped north of 50%, if not more. So, how does that impact the value of where the assets have been staked, what they look like, moving forward? Is there a systemic risk involved with that?
Yeah. So, I mean, high level, crypto assets are sort of at this stage, especially in the context of traditional finance, operating sort of at the fringes. And that basically means greater risk. There's greater market risk, there's greater regulatory risk, there's greater smart contract risk. Not to mention, there's counterparty risk, especially, I think with the blow up of Celsius and multiple borrowing lending platforms. I think high level speaking, proof of stake itself is super new. I think people tend to forget how young and experimental this technology is. So essentially what you have at some level is risk capital that is, taking on these risks and battle testing a lot of these protocols, whether at the chain level, which is the proof of stake level, or even at the application level. So, I'm no one to discount the humongous and the varied risks that are available and existent in the market. But that also comes with greater rewards
Right.
at this stage. I think fundamentally, if you're a staker, in my opinion, you should be a long-term holder as well. So fundamentally, if you're long ETH, or if you're long Atom, or if you're long Sol, or if you're long any of these POS assets, there is no reason not to stake these assets to get fixed income on top of them. And essentially, proof of stake is the development of the fixed income markets within crypto.
Fair point. And Tushar, to wrap up here, what does all this mean for the future of crypto?
Essentially, like I said, to my previous point, I think it's the development of the fixed income markets. I think fundamentally, if we see the last 100 years or the last 10,000 years, I think finance fundamentally has remained the same. You have an asset, you use it for payments, you use it for borrowing, lending. You want to move from one asset to another asset. And then obviously recently, we've seen the development of derivatives. I think fundamentally, the building blocks of finance are not being changed in terms of an asset existing, borrowing, lending, moving from one asset to another asset, derivatives taking place. It's just that the technology that is being used is fundamentally different, and the plumbing and the architecture that is being used to create these financial products is a little bit different. I think those are sort of my final thoughts.
Okay. All right, Tushar. Well, we appreciate that. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thank you, Jill.